So one of my New Year's resolutions was to do dry January. And if I didn't accomplish it, I was going to donate $10 for every day I didn't accomplish it to charity. Well, guys, let me tell you when dry January died in my household. It was January 2nd. Let me think back to that day. I woke up so excited about the new year. I love everyone who follows me on YouTube. You guys, we're having so much fun with the planning call. So I want to tell you, I do love that. That's fun. Get on my calendar. Anyways, January 2nd, drinking my coffee. And I start pricing out loans because that's what I do every day. I'm on the phone talking to people. I'm pricing loans. And I choke. And I'm like, right? Not a COVID choke. I was choking because I was in disbelief. And so then I priced out like 5 or 6 more loans. And I was like, oh no. And I was looking at my phone at the market and I was like, oh, not again. Not again. So if you guys have seen my videos, check the February 2021 mortgage update. Very similar. Rates jumped. It's that simple. Rates jumped dramatically. So I'm filming this on Friday, the 6th, and it's been a day where every morning I wake up and the rates are higher. And every day I sit here at my desk and I'm on the phone all day, but my cell phone is constantly dinging with market updates, and they're not the type of market updates I want. Ding, ding, ding. It's like a stab to the soul every time, because I know every time it dings, it's just going to upset one of my clients. So yeah, rates have jumped a lot. So the big news in January is rates have jumped. Okay. Well, so what does that mean? Well, I mean, it's been really dramatic. Usually when you see stuff in the market where it's this dramatic, I'm talking like 2.875 last Friday to 3.375 today. That's dramatic. Okay. When you see stuff that dramatic, usually, it takes a couple weeks for the dust to settle, and then you find where the real new level is. Okay. It's kind of like, no, I'm not going to do a tidal wave analogy. I restrained. Okay. So look, it's going to take a couple weeks for us to figure out where rates are going to settle. Like when I'm talking to people and they're like, well, I want to rate shop everyone today, because I'm going to be in contract in 4 months. I'm like, today is not the day. You don't rate shop people for the future in the middle of an incredibly volatile week, because we don't know where the dust is going to settle yet. So keep that in mind. Also, if you feel like your lender's now ripping you off because they quoted you in December and the rate's a lot higher now, guys, it's been a really bad week here, like for all lenders. So be mindful of that. I'm going to have a video on Thursday about how much every 0.25% increase, how it affects your payment. And it's really not that bad, guys. It's $14 per $100,000 for every quarter increase. Okay. Okay. Now, what's the other thing in January? Man. Okay. So Fannie Mae and Freddie Mac is where everyone sells conventional loans to. Okay. It's that simple. And they recently came out with a new loan level pricing adjusters that they're putting on 2 segments. Now, let me give you guys a little bit of a history lesson, because this is important. In 2020, Fannie and Freddie announced a market adverse fee on all refinances. So what that did is it made the rates on refinances much higher after they put in that additional fee. Okay, they made the cost of doing a refinance more expensive for borrowers. Okay, so they rolled that back because there was a huge outcry. It was like, what are you doing? Rates are at historic lows. People want to lower their payments. Why are you adding this 0.5 point charge? Like, what? Like, we want people to have low payments and be able to afford groceries. Okay, so they roll that back. And then last year, they added a loan level pricing adjustment for second homes and investment properties. So once again, more fees, which made it so that those 2 segments had higher interest rates. Okay, and once again, huge outcry. What are you doing? You're making it so that the average person can't buy an investment property. Why are you doing this? We're all confused, right? Huge outcry. Great. They roll it back. Okay. So this has happened twice. And, if you look at the numbers on how much money they made off of these increases for however many months they lasted, it's a little bit staggering. Well, here we are. So effective with loans that are sold on April 1st, so this will kick in a heck of a lot sooner. The new categories that they are targeting this year are going to be second homes again. So I'm wondering if like the investor lobbying league or whatnot last year was really persuasive, but maybe there needs to be a second home league. I don't know. So second homes again, the rates are about to go up. And this is the one that I'm really upset about, conforming high balance. Okay, so what is that? Here's the deal. Across the country, the conforming base limit is 647,200. Okay, 2022, that is the base limit around the country. Well, there are parts of the country that are incredibly expensive. Incredibly expensive. Has anyone been to the Bay Area? It's really expensive. You know, most of California, right? Washington, Virginia, New York, New Jersey. I mean, I can go on. Connecticut, lots of states have loan limits that are higher than this 647,200 in specific counties because of how expensive it is to live there. So what happens when you're in a high cost area is the limit's higher. So in San Francisco now, it's like in the 900s, right? Well, so what Fannie and Freddie have decided is, hey, if your loan amount's over 647,200, if you're in that conforming high balance where you're already dealing with having to buy an incredibly expensive home to stay close to your job, well, guess what? We're adding more loan level pricing adjusters to those loans. So those loans are about to get more expensive. Yeah. So, you know, what are we going to see from that? Well, you know, when people in my branch and my team first saw that, everyone's response was, oh my God, not again. Like, is this a joke? Like, we looked at the adjusters. I'm being really honest here. Like, if I upset someone at Fannie or Freddie, like, I don't know what to tell you guys. Like, this isn't, like, punishing people in high cost areas. Like, they're already dealing with the fact that their starter home has to be $1 million. And I know a lot of people think, oh, well, they're probably making 4 or 5. They're not. It's like multiple income levels, you know, multiple people having to buy together in order to buy, and then increasing fees on that so that then they're paying higher rates. It's like, yeah. So that's happening. But okay, so everyone was really upset, and I was like, okay, well, how do we problem solve this? Hopefully they will roll it back. However, you know, okay, we've got to get our borrowers ready for jumbo. That's what it is. So, and in the past, we had something similar where the conforming high balance was more expensive. And so what we do is we qualify people for jumbo, because most jumbo investors will have it where if you're conforming high balance, you can do a jumbo loan. Okay. Now this is very complicated and lender-lease, but the bottom line is there are options. However, you know, are you going to do a jumbo loan with 5% and no reserves? No. Can you do that with Fannie and Freddie? Yes. So it's going to be really important if you're working with a lender that's not me, which would be really sad for me, to talk to them about this, because that's what I'm going to be looking at with my team is, hey, when I'm looking at pricing, does this person also qualify for one of our jumbo programs, and can we get them a better rate? Because with these huge market swings, the one area of the market that doesn't move as much is jumbo. It's that simple. So that's really what I see happening. And I don't know if Fannie and Freddie are just trying to make it so that they don't have as many loans being sold to them. I'm not sure what the end game is. You know, I'm a peon in the world of lending, but it's something that you guys need to know as buyers is that, you know, if you're in the conforming high balance category, you're going to be paying more. If you're buying a second home, you're going to be paying more. So keep an eye on this stuff. Let's see here. I mean, those were the big things, just the rate jump, new added fees. You know, people are a little bit depressed about the inventory right now. I've had a couple calls just today about, you know, fear of missing out. It's January, guys. There's no inventory. I've covered this before. So you really just want to keep in mind things will get better with spring. You know, rates jumped, but they're still historically low. Like, you know, I was talking to a client today who actually he had been a kid in the 80s, and he was telling me about how his parents used to always be like, oh, this interest rate, and it was 17 or 18%. And here we are today, and I'm talking about, you know, 3.1, 3.3, 3.5, and I feel like I'm, you know, abusing someone because the rate's so high, whereas we're still really low if you look at this historically. So don't go on negative. Don't Don't go all dark. It's gonna be okay, I promise you. We're doing a ton of plans with the people. So if you guys need your plan to buy in 2022, please reach out. There'll be a link to my calendar. There always is in every video. I do appreciate you guys. If you feel like there's something I didn't cover in this video and you have questions, as always, please post a comment. And I'm licensed in 48 states, so feel free to reach out.